Welcome to the daily insights that matter. Now, taking a new leap in the road infrastructure, the government has revised the highway construction target and set an ambitious goal for fiscal 2024. Let's look at this one. Now, the government has raised its ambition and set a new goal of constructing 13,800 kilometers of roads, surpassing the initial target of constructing 12,500 kilometers of roads set at the beginning of this financial year. Now, this objective aims to outperform the best performing year where the government had managed to complete 13,327 kilometers of road construction in FY21. Now, during the first quarter of this fiscal year, the government has already completed construction of 2,250 kilometers of roads, investing a substantial amount of 99,273 crores. Now, it's worth noting that in the last 6 years, the government has only achieved its road construction target once, making this new goal a bold and a very ambitious one. Now, the government has set a capital expenditure target of rupees 2.58 lakh crores for the entire year, with the intention of utilizing at least 90% of that by spending it till the month of December. Now, during this period, they also plan to complete 310 highway projects. Now, the addition of new roadways has resulted in record-breaking toll connections as well, with toll collections reaching 48,028 crores. That is a remarkable 41% rise compared to the previous fiscal. Now, the ambitious goal of constructing 13,800 kilometers of roads represents a significant step towards infrastructure development, promoting economic growth and enhancing connectivity nationwide. However, it's important to note that adverse weather conditions, clearance delays and rising input costs may pose challenges and potentially slow down the progress of some road projects. Multiple global debt fund managers and the IMF are pushing for the inclusion of India's sovereign debt in their indices. Let's discuss this as well. Global bond index providers have shown interest in including India's sovereign debt on their indices, as the exclusion of Russia from the international capital markets has created a need to incorporate a large emerging market economy like India. Now, the IMF also stated that India's expected inclusion in the international bond indices could have a significant impact on the country's bond market, attracting greater foreign participation and supporting portfolio inflows to finance the current account deficit in the medium term. Now, it emphasizes that volatile portfolio investments are highly sensitive to changes in the global financial conditions and country risk premium. However, the Finance Ministry has been hesitant to offer any tax incentives such as rationalization of capital gains tax for the inclusion of government securities in the global bond indices. Nevertheless, the IMF believes that India's inclusion in such an index would exert pressure on the government to maintain fiscal discipline and ensure that its bonds retain investment grade status. Now, the report highlighted that India's trade and capital account regimes are still relatively restricted despite some progress in promoting external trade and liberalizing foreign direct investment and the foreign portfolio flows as well. Now, the IMF suggested that further structural reforms and improvements to the investment regime would be necessary to promote FDI and enhance external rebalancing. Now, the IMF has projected India's current account deficit to narrow to 1.8% of GDP in FY24 from 2% in FY23, driven by buoyant service exports and an expected decline in the oil import costs. However, it is expected to converge back to its estimate norm of 2.4% of the GDP over the next medium term. Now, in the near term, the government's additional infrastructure spending is expected to raise current account deficit, but fiscal consolidation, development of export infrastructure, negotiation of free trade agreements and investment regime liberalization could facilitate external rebalancing in the medium term. Structural reforms aimed at deeper integration into global value chains and attracting FDI would help mitigate external vulnerabilities. Exchange rate flexibility would serve as the main shock absorber with limited intervention to address disorderly market conditions. The report also recommended that given India's moderately strong external position and adequate forex reserves and forex interventions should be restricted to addressing disorderly market conditions. In 2022, the widening current account deficit and outflows of foreign portfolio investments led to a depreciation pressures mounting on the Indian rupee. However, these pressures eased and reversed when the current account deficit narrowed and investor sentiments improved in the second half of 2022 and early 2023, resulting in an appreciation of the average real effective exchange rate for the year. Having said that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com